Welcome to the latest Nest Egg monthly ETF update, the show where we show you, the investor, a bit of an insight to what's been going on in the ETF market over the last month and a little bit about what me and Kanish think into the month ahead. Kanish is back again. Welcome back, mate.
No, thank you, David.
And I think we're just going to jump straight into it, Kanish. I think we just want to get an idea of the latest and greatest in the ETF world. What's kind of been happening since we last caught up?
The ETF market, it's been really interesting. So since the start of the year, in January, at the end of January, the size of the ETF market hit 42.3 billion. Now, what does that mean in terms of figures? Obviously, you've seen a bit of a rally in markets over the months of January and February, but that 42.3 billion, that actually, at that point in time, it meant that the ETF market was larger than the Australian LIC market. Now, I think that's a feat in itself. It's the second time that's happened. The last time was mid last year. But I think what we did see last year is when the ETF market outgrew the LIC market, you then saw a bit of change in equity markets and sort of a bit more volatility, and it sort of pretty much they traded it in line with each other. What you may see moving forward now is the ETF market will continue to grow, and the LIC market has had some issues. I think active managers have sort of struggled in terms of performance. There's a lot more popularity with ETFs, a lot more products. So you'll start to see that the ETF market will continue to grow, and I think you'll start to see a bit of sort of a gap between the LIC market and the ETF market, which is, you know, given the LIC market's been around for decades and the ETF market only really 16 years, 17 years, you know, it's an interesting achievement. It's a great achievement.
For anyone that's not 100% aware, LICs and LITs, LIC is a listed investment company and LIT is a listed investment trust. Now, compare that to an ETF. How much different are they in essence? Is there a massive difference, or is it kind of just a different vehicle that they're trading on here?
Yeah, they're very different. So yes, both are investment vehicles. You know, both provide exposure to a basket of stocks. An ETF though, the basket of stocks generally has been passive. So you know the benchmark that you're trading in or that you're getting exposure to. And it's not just equity stocks. You could buy into a commodity ETF or a currency ETF or a fixed income ETF. But the key difference that all investors need to understand is a LIC is closed-ended. So what that means is that there is a set amount of units within that product, and they don't have a market maker, an external market maker that sits there and maintains the price. So if there's a set amount of units, the trading price of that product will move with supply and demand of that product.
It's amazing to see that change in there. It's happening really quickly. Yeah,
and majority of LICs trade at a premium or discount. Whereas an ETF is open-ended. So as we see increase in demand into our product, we will have to buy more units to reflect that demand. So exactly like a managed fund.
Yeah.
So if you think of an ETF is similar to a managed fund, but it's listed.
Perfect.
So you get intraday trading, it's open-ended. So the price of what you're looking at on screen and when you're trading it should be reflective of the underlying net asset value of that particular exposure.
Perfect, brilliant, good explanation. I was actually looking at as well, we were talking about this before, and the whole difference compared to where we were this time last year to now in the market, just in general. There's been obviously a massive uptick in terms of not just ETFs, but the general economy, and that's had a massive effect on all of the ETFs trading on the exchanges at the moment.
Yeah.
So you were telling me that there's an obscene amount of numbers of ETFs that have traded in positive territory.
Yeah, this is really interesting. So around the figures, and for the whole month of February, and this is, you know, we had reporting season here in Australia, but the whole month of February, we only saw 9 ETFs that had negative returns. So that's out of 175 plus products, you only saw 9. Now that's pretty amazing to see. I've never seen that in my few years in the ETF market here in Australia.
So I guess that links pretty well towards, you know, obviously, like you said, companies are in reporting season. For anyone that's not aware, reporting season is where companies release their latest financials. But I think going back to that, it's one of those things where also that can cause certain types of discrepancies or opportunities in the investment world. So what would you say investors should expect during that reporting season?
Yeah, look, I think what we saw in reporting season, it may not affect all individual stocks, but when a company reports, if that report is negative or positive, it can have a drastic impact on its underlying share price. Now, there are some stocks that we saw that move up 30-40% and some stocks that move down 30-40%. So what we do see though is that there are ETFs covering the Australian equity market. You have broad-based Australian equity ETFs, so you have products like STW, which is from State Street. That's the largest ETF in the market. That covers the ASX 200 index. So it pretty much does what the market does. You have Australian equity yield products like ZYAU from ETF Securities. You have sort of other factor-based like equal weight from VanEck, or MVW. So that theoretically is basically 80 companies from the Australian market, all equal weighted. So, you know, you pretty much are buying into those 80 companies and they're exactly the same weight. So what we see is those ETFs, they don't have those large fluctuations. They're buying a basket of stocks. So if you're buying a basket of stocks, there's diversification within that exposure. So, we saw ZYU or STW move up 7-8% over that month. But where you see individual stocks have that large sort of moves and they can be quite volatile, sometimes investors need to consider, well, if during reporting season, am I aware, make sure within your portfolio you know what you've got exposure to. Is it better to maybe have a wider diversified portfolio via an ETF? And then tactically using some of these sort of direct stocks.
I suppose when obviously you get these big swings or not so big swings with reporting season as well, but I suppose that could also maybe, it's not just a one particular initiative, it could possibly set the trajectory for the rest of the year in essence. Do you think that's plausible?
Yes and no. I think, from a perspective of there has an impact on the wider portfolio, but investors need to understand you're buying for the long term, especially on the ETF side. Generally on those products, your time horizon, investment horizon should be between 3 to 5 years. So, buying it just because of reporting season and, seeing those big shocks and making decisions off the back of that, I don't think that's fair. I think, whatever product you're buying into, look at, making sure your portfolio is diversified across different asset classes, even within those asset classes, diversifying it even more.
I think the reporting season, in essence, is just another factor that you should take into consideration across many different things of that particular investment, right?
Yeah,
it's not just a one-off thing.
No, and I think it's mainly if you've got single stock exposure, you need to consider reporting season a little bit more because there could be larger impacts on your portfolio.
Absolutely. And also, you were just telling me as well, I'd like to learn a bit more about this, but there's the Inside ETFs conference that you were discussing. Tell me a bit more about that.
So it's the largest ETF conference around the world. Now it's held in Florida every February. There was about 2,500 investors and sort of attendees at this conference. And the conference that was recently held this year, there were some interesting trends and themes to come out of it. And one in particular was this over sort of arching belief that Facebook, Google, Amazon, some of the largest technology companies in the world will eventually get into asset management. Now, I don't know what that means in terms of how they will get into asset management. They didn't sort of specify. They just had this belief that, when you're talking about investors and retail clients, and when they say, well, I need to understand what an ETF is, or I need to know, what's happening, what ETFs are available around robotics and automation, they will Google it. So some of these companies have such wide, far-reaching, they can access a larger client base. And so from their perspective, they were thinking, well, there will be in some time, some way in which these companies will get into asset management. It could be around active, it could be around doing ETFs. Maybe it could actually be around, the underlying index. They're sitting on a lot of data. And, you see that with Facebook, the collection of data that they have and the trends that they can then sort of determine from that. So maybe they'll go down that path. I'm not sure. But it'll be interesting to see. I don't think we'll see it here in Australia in sort of the near future, but definitely I think there's something to look out for.
I think that'd be incredible to see some of the most wealthiest trillion-dollar companies in the world coming into that space. And that could, obviously we don't know what's going to happen, but that could really set a precedent or a shake-up for the more custodian, which are the sort of more longer-term investment or institutions which have been out there. And the new guys are on the block.
The established players,
Yeah, they come with all the data under their arms. And
this pure startup style of it. But the other thing to consider is, would they come in and acquire an existing player? Or they've obviously got enough cash, and you look at Apple, $1 billion plus in cash reserves. Or do they just sit there and set something up themselves? They don't need to buy an existing operation because of brand, I don't feel. They've already got quite strong brand reputation, sometimes negative, when you can talk recently about some of the data breaches of Facebook, for example. But that's something that they may consider as well.
The world is their oyster when they're $1 trillion.
Essentially, yes.
And I think that also brings us over to a very awesome point of active ETFs and smart beta. So very lightly, can you just explain to the reason listeners out there what that means?
So an active ETF, or an EQMF, exchange quoted managed fund, it's essentially an active manager, an active fund manager that's listing their product on the exchange. So it operates similar to an ETF in the way in which you have a stock code, you can buy it on exchange, but there are different reporting requirements for an active ETF versus a passive ETF. The other thing to consider is that with an active ETF, it's still an active fund on the underlying. So the fees that it would charge is still can be quite high versus a passive ETF. With a passive ETF, you will essentially know all the rules, you'll know all the inputs behind that product. Now, smart beta. This is a sort of an interesting one. Smart beta or rules-based approach. I think smart beta puts a lot of people off. When you're talking about just a market tracker, that's essentially beta. That's you're buying just the risk of the market. When you're talking about smart beta, that was just sort of a term coined, I think, over in the States. That sort of is just sort of multiple factors on the underlying index. It's still passive. You still know what makes up the portfolio. You still know all the rules and when they're applied. It's more than just simply the market. So it could be as simple as equal weight. So it could be the Australian market, but instead of, all stocks are sort of ranked by order of size, they're equal weight. It could be just having a volatility screen. It could be having a yield screen. So there's just multiple rules that are applied over the traditional indexes. That's what smart beta is referring to. And you're seeing a bit more of the advent of that because it moves away from just traditional market returns.
And also as well, we were talking about another opportunity where every single month now we want to talk about, because there's so many of them, an ETF myth.
Yes.
And we want to bust that a bit. So I think the most important one, and probably one that you get a lot when your conversations with investors, shares live in the same place as ETFs. They're both on the exchange. They're both in the same house here. Look, do ETFs trade the same as a stock?
Yes and no. Is the best way to answer. Yes, in the sense that they live on the exchange. They have a stock code attached to it. So when you trade an ETF, you're trading it like a stock. So you would still put in the stock code and you trade it on, whether it's through your financial professional, whether it's through an online brokerage platform like Bell Direct, CommSec, etc. There are many out there. But the key difference between this is a stock has closed-ended. So, we talked about that before with the LIC, so similar to a LIC, it moves up and down based on the supply and demand on that particular stock. Also, with certain stocks, they are having high volume. So something like BHP or Telstra, you're going to have a lot of individual investors, a lot of institutional investors. So when you're looking at the actual trade screen or when you're trading the product, you may see multiple orders both buying and selling. With an ETF, we don't need to have traders on both sides or investors on both sides for that stock to be liquid. An ETF is open-ended, as I mentioned. So if an ETF has $1 million in assets under management, has $1 billion in assets under management, that doesn't affect its liquidity of the underlying. The thing that affects the liquidity of the underlying and what investors should understand is what's the underlying exposure. If that underlying exposure that the ETF is investing in is liquid, then they will be able to buy in and sell out of it as they need to. And the order book, or what we talked about before, that will look very different to a traditional stock. So that BHP, whereas multiple hundreds, maybe even thousands of people buying and selling, an ETF may have 10, may have 20, may have more if it's a bit more of a popular ETF, but it may not have that much on the screen. And that's nothing to be scared of, because with an ETF, we have what's called a market maker. And the market maker is a third party. They're sitting there making the market for the ETF to allow investors, whether it's retail, whether it's advisors, whoever that may be, to trade that particular product. So there's nothing to be concerned of there. Just understand what is the underlying exposure and is that liquid.
Yeah, perfect. Myth busted, I guess.
Hopefully, yes.
And by all means as well, if you'd like to submit another myth for next month, do get in touch. We'd love to see if you have any questions that you really want to know about the market. Kanish is the man to answer them for you. Kanish, thank you very much again for coming in.
No, thank you, David.
And also as well, if you want to catch up on any of the other episodes, you can look back on the channel below. All the links are in there. Or you can also follow more about ETF Securities in the links below as well. Until the next one, see you there.